Okay, I'm just sharing my screen. So we have okay, open the next question of section B. Okay. Which was that question? I think was question 3. Open this question 3, please, from your practice platform. Question 3. Now, this question is a very good question again because they are actually testing a lot of standards. Predominantly, it is being tested from IFRS 15, then discontinued operation IFRS 5, IA 16 land option of purchasing, I think IFRS 9, etc. I've not seen the requirement, so I believe it is IFRS 9 because it's options. Yeah, it's options IFRS 9 only. So, as you know, SBR is all about explanation and giving discussing the details of the accounting treatment. So we have to be very clear in our mindset that what should be our approach towards this examination. So if you look at here, the marks are spread across various requirements: 8 marks, 7 marks, 6 marks, and 4 marks. 8 marks is for IFRS 15, 7 marks is for IFRS 5, 6 marks is for fair value of the land, and then 4 marks is for the options. Okay. So let's first look at the first requirement, which is IFRS 15. Okay. CL entered into a contract with a customer heat company to sell a hardware packaging comprising a computer monitor and a printer. Okay. For $2,000. CL will supply each of these 3 products at a different point in time in according to the needs of the customer. CL regularly sells the computer parts separately for 1720. However, the monitor and printer are new models and are not yet sold separately. CL knows that the competitor companies sell a similar specification of printer for $180, which CL feels reflect the entity's costs and margins. The cost to produce a monitor is $150. CL company achieves a gross profit margin of 25% on the selling price of its product. Okay. So what do you think should be our approach to the answer? What is the requirement? Using exhibit 1 with IFRS 15, discuss how CL should allocate the transaction price to the package sold to Heed and Company. So it's a very simple question. It's allocation of transaction price, which is something that we have already studied. How do you allocate the transaction price? Based upon the standalone selling price of the products the company is selling, right? So here, when we see that this particular question, we will believe that, oh, you know what, it is very simple. But however, you look at the marks or the requirement. What is the number of marks? 8 marks. So for calculations, you might be getting around, let us say, for calculations, you might getting around, maybe, let me just check for the calculations, how much you will get. Yeah. Yeah. For the calculation, you will be getting 2 marks. Okay. Discussing the principles of IFRS 15, you will be getting 2 marks. Okay. Discussion of the each component, like computer, how you will allocate the transaction price, printer, how you will allocate the transaction price, monitor, how will you allocate the transaction price, you will be getting 6 marks, right? So 6 marks. Yeah. Right. So 2 marks for the principles, 2 marks for the calculations, and then, sorry, and 4 marks for the remaining 4 marks for the discussion of each of the element. Right? Understood? That's how it is. It has been spread across. Okay. So how will you, first and foremost, whenever there is transaction price allocation, what will you do? Again, whenever there is requirement for workings to be shown, I suggest you do the workings first so that you know what you are going to write in the paragraphs above. Correct? So you show the working above. So I'll create a table. Okay. Create a table and I'll mention it as working calculation. Right? So we have our 3 aspects, which is particulars, then stand alone price, then working how do you insert a new column? I cannot insert a column or what? Insert a column after. Okay. And then you have standalone price and then you have transaction price. Even for the exam. Okay. Right. So you have computer, which is the standalone price is 1720. And this is transaction price. Okay. Okay. All right. Then working will be 1720. Okay. And then you have monitor printer. So what are the products you have? You have computer, you have monitor and then printer. So printer, then monitor, correct? So then you have total. So total transaction price is $2,000. So this 2,000 will have to be allocated to each of the component, correct? That's what we are supposed to do. Now, what is the standalone price of each of the item? Standalone price of monitor, computer, where is it? It is given as the the competitor company sell a similar printer for how much? $180, right? The cost of production of monitor is 150. So 180 and then 150. So what is the total? 1,710, 20 plus 180 plus 150. How much is that? Two, no, 7,720 plus 180 plus 200, right? Okay, wait. Sorry. It's 150. Okay, this is the cost of production. This is not the selling price. Sale achieves a gross profit margin of 25%. My mistake. So if 150 is the cost, we achieve a margin of how much? 25, correct? So how will you calculate the what do you call it? Selling price? 50 into 150 into 25 divided by 125. Okay. 150 into 25 divided by 1 second. 150 into 25 divided by 125. Is this coming correctly? Okay. No, 150 into we need the selling margin, right? We need margin, right? What you said is just markup. It's not margin. Yes, 20, not out of 150. See, this is 25% is margin. So whenever there is margin, you need to assume your selling price is 100 and your cost price is 100 minus 25, which is 75. Here 150 is 100 or 75? 150 is 75. No, because it is cost. See, whenever you identify margin, okay, I'll explain to you in a different way. Okay. So that is selling price. No, yeah, even yeah. So this is 150. If it was selling price, we don't need to do anything. No. So this is 150. Your margin, okay, margin is 25, correct? This 150 is your cost, correct? No. So you need to understand that to identify your sale value, you need to understand that the sale value margin is 25%, correct? So your sale value will be at 100%. So your cost value is at 75%. So your sale value will be 150 into 100 divided by 75, which will be 200. So that will be 200. So 200 will be your margin. Sorry, 200 will be your sale value, not margin. 200 will be a sale value. So total will become 1720 plus 180 plus 200 will be 2100. Now, how will you do the allocation? You allocated the 2000, okay, based on our standalone selling price, which is 2000 into 1720 divided by 2100. Then 2000 into 180 divided by 2100. Then 2000 into 200 divided by 2100. So what is the total? 1638. Then 171. 19. Okay, but it will not, there will be round off error because the last digit will be 8 plus 1, 9. It won't be 2000. So is it one? Is there decimals? Just check if there is a decimal. Then we'll put it as decimal because otherwise it will not round off. 0.7.5 and this, yeah, this again it will be 1. Is this correct? Or we have to put it as 191. Shall we put it as 191? Is this enough? This is okay, no? 191, 171, 1638. Okay. Yeah. Yeah, 191. Perfect. Okay. Correct for him, 191. So now we need to answer this question, right? This is all the calculation that is required. So now we have to score this calculation. You will get only, how much is the maximum marks? 2 marks. Now you have to score remaining 6 marks out of explanation. Correct? How will you explain this? How will you explain? First, explain the concept or explain what the standard says, right? So I'm just going to show this, right, as an explanation. So as per IFRS 15, revenue should be allocated. Okay. Revenue should be allocated. Revenue should be allocated based on the transaction price, the total transaction price to each component based on its proportion of the components standalone selling price. Okay, revenue okay, I'm just going to rephrase it. Okay, so I'll take the total transaction price, revenue, as per IFRS 15 revenue, the total transaction price. Okay, I'll put it in this way, should be allocated to each component based on its proportion of standard selling price of each component sold. Okay. Now the standalone selling price, so you explain what is the standalone selling price because you need to score marks, no? So the standalone selling price is the price at which entity would sell the goods or service on a separate basis to its customers. Right? Now, as per IFRS 15 states that the observable price of a good or service sold separately provides the best evidence of a standalone selling price. So if you are separately selling a price or a particular product, and what is the price of that will identify the standalone selling price. Okay. If the stand alone selling price are not readily available, the entity should estimate the selling price of each component of the contract using all the information available. Right? Now, you look at this. CL entered the contract. CL regularly sells computers separately. However, the monitor and new models are not sold separately. We can use this in our scenario. Okay. So I'm going to copy this. Okay. And paste it over here. So CL company sells the computer separately for 1070. However, the monitor and printers are new models and are not yet sold separately. Okay. So you can say that because the stand alone selling price for printers and display screens are not directly observable, CL must estimate them using all available information, maximizing the use of the inputs. Okay, I'm not all information. I don't want to mention the last sentence. It's not necessary. Okay. Now we should justify why we can use the competitor's price for the printer, and then why we can use monitor the cost approach. So we should justify our approach, isn't it? You understand? So to estimate the selling price, what is the approach that we are going to use? So we can say that to estimate the selling price, correct, CR will use an adjusted market approach for printers and an expected cost plus margin approach for the monitor. See, when you're showing this as your calculation, when you're showing this amount as your calculation, you need to justify that why you are choosing that amount. right? So now we need to explain what is adjusted market approach. So the adjusted market approach focuses on the amount which the entity believes the market to which it sells or services is willing to pay for good or service. In this case, CL can refer to competitors' prices for similar goods or service. Right? So you can say CL knows that the competitor sells for, which you can copy this also, because this is a very good explanation. Can you just see the sentence? So we are going to now, we have justified why we are using market approach, and we have justified what is market approach, which is nothing but competitors' prices. So we can say that we can copy paste this, that CR knows that the competitor company sell a specific of printer for $180, which CR feels reflects the entity's cost and margins, right? Right. So hence we can say that hence standalone selling price of printer can be used as $180. Done. Okay. Are you following the flow of the answering? So first you explained the question, explain the standard. Then what did we do? We kind of identified what are the approaches we are following. Then we have to justify as per the standard what is the approach, whether it is right or wrong. And then we have decided that this is the approach that we can take. Right now we have to justify for the next cost approach, right? So the expected, you can see if you can write the cost to produce. Yeah, this we'll take it later. Okay. The expected cost plus a margin approach focus on entities cost of production, but must reflect the margin the market would be willing to pay. And then you can say that you can copy this sentence. The cost of production, CL believes, CL, okay, achieves a gross profit margin 25%, right? Therefore, the stand alone selling price of the monitor will be $200, which will be $150 divided by 75 into 100. Right? So you can say that the total sum of standalone selling price is $2,100, which exceeds the transaction price fixed of $2,000, Hence, the total transaction price is allocated proportionately across the three products based on the standalone selling price as mentioned below. Clear? Any questions? Right. So let me give you the marking schema. Right. So let me give you the marking schema. If you look at here, requirement, there is no professional marks which is mentioned. Okay. So here to explain this, okay, to explain this principle of the standard IFRS revenue for the principles that you are explaining, you will get 2 marks. Okay. Calculation is 2 marks. Then all of these you are explaining, you will get how much marks? 4 marks. Understood? So it could be, it will be, okay, to explain this, this is straightforward. So you will get 1 marks for this, correct? Right. And then this, these two, to explain these two, you will get 3 marks. So total will be 2 plus 1, 3 plus 3, 6 plus 2 will be 8. Understood, right? This is how the marking schema will be for the entire 8 marks. See, majority of the times, what I have seen in students, okay, one thing is that whenever such question is asked, students do the calculation. Such question is asked, students always does the calculation. When it comes to explanation, they never write about the printer and monitor, how the printer and monitor standalone price was fixed. There is a complication in that. It is not straightforward. They have not given you the printer and monitors amount straightforward. They have given to you the computers amount straightforward, which is something that you can take. But printer and monitor, they are not selling separately. So you need to realize that from the standard, if that is not sold separately, you have to do an estimated approach. Isn't it? You have to take an estimated approach. And what is the estimated approach? Either cost plus margin or market approach. Right? Understood? So without allocating any the transaction price to the individual products, you cannot charge the revenue. You understand? You cannot recognize revenue. Is this clear? Right? Any questions? Any questions? Right. So look at the next requirement using Exhibit 1. Exhibit 2, I'm sorry. In accordance with IFRS 5, non-current assets held for sale and discontinued operation, discuss whether the profit on sale of license should be presented as arising from discontinued operations in profit or loss. So again, read the question. As per IFRS 5, discuss whether profit on sale of license should be presented as arising from discontinued operation in statement of profit or loss. That's the question. So look at the requirement. Okay. See, it is for 7 marks. So whenever you are getting 7 marks, right? See, whenever you are getting a standard based question, first thing I always do is explain the standard. You will get 2 marks unless just to explain your standard, you're going to get 2 marks. Why you don't need to waste that money? Or why you need to waste that, explanation? This is very important. You need to ensure that your standard is being explained. Otherwise, you will never understand the requirement. It's like you are not understood the requirement. It's very important that you very clearly identify the standard and explain the standard, because only when you explain the standard, you will understand what exactly the standard is and how you need to approach the standard. Okay. So, so let's look at here the discontinued operation. CL purchased and then subsequently sold a license. The income it generated was small in context of the overall business. CL buys license with a view to reselling them. At any point in time, it owns several software licenses. The profit on loss of this license was presented as arising from discontinued operation in statement of profit or loss. This was because CL believed that the license was a separate component of the business. Okay. Now, what is the requirement here? The requirement is whether the profit or loss on selling this license can be recognized as a income in your profit or loss. That's what profit or loss statement. That is a requirement, correct? Isn't it? Yes or no? Have you got the concept? So what are they doing? See, license is an intangible asset. Like any other asset, when you buy and when you sell, you will get a gain or you might have a loss. You might incur a loss, right? And whatever buy and gain you do, are you allowed to recognize that in your profit or loss is the question that they are trying to answer. Is it clear? Right? So what we should write first and foremost, we need to identify as per discontinued operation, as per IFRS 5, whether what is IFRS 5 definition of a discontinued operation. That's what first we should write. What is IFRS 5 definition of a discontinued operation? A discontinued operation is a component of an entity which can be either has been disposed or is classified as held for sale. One is represents a major line of business or a geographical area, is a part of the single coordinated plan or a major line of business or a geographical area. Third, a subsidiary which is acquired with a view to resell, right? In as per IFRS 5, the term component of an entity, right? The term component of an entity, right, comprises of operations and cash flows, which can be clearly distinguished from the entity. Only then you can say that it is component of an entity. And second, a component of the entity should be a reportable segment, isn't it? So if you want to classify an entity's component as a separate component, you should be able to classify it as an operating segment or as a reporting unit or as a subsidiary or as an asset group. Correct? Usually component is a single cash generating unit. Correct? But is a license likely to be a component of an entity? Is a license, software license, likely to be a component? Can you generate cash generating unit just from the license? Can you say that it will be a reporting entity? Can you say that it will be a subsidiary or an asset group? No. License independently is not a component of an entity, isn't it? Huh? Okay. Yes. The assessment of a separate major line of business is based upon the size and relative importance to the business. Okay, you don't need to worry about all those things. The licensing revenue from the price of the software was relatively small in terms of the overall license. Correct? So if you look at here, the income generated is small. This is a very important sentence. If you want to highlight a component or if you want to highlight an operating segment, generally it is at least what 10% of the total revenue. Right? But here it is very small. Correct? However, as per the standard, do we go only by the numerical aspects? No. Right? We need to look at the substance over the legal form. And we also need to look at materiality by nature. The sale of a license was not due to a coordinated strategic decision to end a separate line of business, but it is a normal operating course of the business, isn't it? As you can see, they did not. What did they do? They purchased the license, they used it in the license, they used the license in the business, and they sold. It didn't happen like that, right? They are happening it in a normal course of business. It seems like their business is actually to sell licenses, purchase license and sell license, right? Correct, no? So even though license has been purchased with a view to reselling, it does not constitute the important element of subsidiary acquired with exclusively for resale. Therefore, license was just one of the several individual sales. In conclusions, none of the criteria in IFRS are fulfilled, right? And you cannot classify the profit on sale of license with the discontinued operation as they are inappropriate. This is the conclusion. Is it clear? Right? I'm not going to write everything in detail. I would like you to write it down. So let me summarize whatever we have said. So firstly, what is a discontinued operation? So I'm going to write the definition or the explanation of a discontinued operation. Discontinued operation is, number one, represents a major line of business or geographical area or operations. Second is a part of single coordinated plan to dispose of a separate major line of business or a separate major geographical area of operations, a subsidiary with a view to resale. Right? So you need to explain each element over here by linking with the license. So as per IFRS 515, so as per IFRS 5, component of entity comprises of operations and cash flows which are clearly distinguished from rest of the entity. And the component of the entity must be reportable segment, reporting unit, a subsidiary, or an asset group. And a component is usually identified at a level higher than a single cash generating unit. And hence, license is unlikely to be a component of an entity. Right? You can say the right. Second one is that the major line of business is based on the size and relative importance to the business. The revenue generated from license are relatively small compared to overall context of the business. Right? Further, the sale of license was not due to a coordinated strategic decision, right? Whereas appears to be over a normal course of business, which includes continuous change to the composition of licenses. Okay. So even though license was purchased with a view of reselling, it does not constitute a subsidiary acquired exclusively for resale. Therefore, the license sold was just one of several sales and none of the criteria of IFRS 5 are fulfilled, and classification of profit on sale of license within discontinued operation was inappropriate. So they should be classified as revenue. You understand? Revenue, whatever is the amount of money we got from the sale of license. So let's say, for example, I purchased license from Shreya for $100. I sold it to Monis for 120. So my revenue will be 120. My cost will be 100 because it seems like that's how they are generating this, right? Or it should be from other income. It should be mentioned as continuing operation, isn't it? Within normal profit or loss itself, other income, sale of license. Whatever is the profit or loss, you put 20, or if it is a loss of 20, you mention that, right? It cannot be, you cannot create a discontinued operation format just because you are purchased the license with a view of resell. No, it doesn't classify the subsidiary category. It doesn't classify the definition of a major component or anything. It's just a normal asset. Okay. Okay. Any questions? All right, fine. Okay. So, next is land. Okay. Look at the next requirement of land. Using Exhibit 3, discuss how the land and its fair value should be accounted for in the year ended 31st December 2000 X7. Right. So, what happened to land? On 31st December, CL acquired a land for 10 million. The intention was to turn it into an employee car park. The cost of the land was recorded as property, plant, and equipment. By 1st September 2007, the land had developed into a car park. Many employees had started working from home, meaning that car park was no longer required. So CL decided that it would lease the land instead. CL classified the land as an investment property and measured it at original cost of 10 million. Okay. CL wished to use the fair value model. However, as at 1st September, CL believed that it was impossible to measure the fair value of the land due to legal complications in public areas. A nearby plot of land, very similar size with similar legal complications, sold in September X7 for how much? 11 million. On 31st December, the legal issues were resolved. CL hired a surveyor who stated that the fair value of 11.5 million at this date. CL calculated the fair value gain of 1.5 million as a difference from the original difference between 10 million and the fair value of 11.5 million, and this gain was recognized in profit or loss. Okay, is it clear? Right now, first and foremost, what is the standard talking about? There is a shift, isn't it? So it's a very good question. It's a simple question. Okay, it's a simple question, nothing complicated. That's why I'm telling you, for an exam pattern question, this is a very good question. So what has happened here? If you can analyze what is the situation that has happened, right? For a minute. If you look at here, what has happened? We purchased the land at on 31st December, right? And for how much? $10 million. Then what happened? On 1st September, what did we do? We converted into leased as an investment property, right? So here on 1st January, so our accounting year is, what is our accounting year? 31st December 2000 X7, isn't it? Accounting year is 2000 X7, correct? So we, on 1st January 2000 X7, right? We had this land, correct? Till 1st September 2000 X7, this was under which model? IAS 16, correct? Property, plant and equipment. Correct? Property, plant and equipment. Now, so we purchased on 31st December with the 10 million and turn it into an employee car park. The cost of the land was how much? 10 million, correct? Now, property, plant and equipment cost was how much? 10 million, correct? Should we calculate depreciation? Yes, no. Why? Perfect. Very good. IA 16 carrying amount, but it is a land. Land is never depreciated. No, it's not revaluation at all. It is never depreciated. Land are never depreciated. So it is land, hence there is no depreciation. So the value will be at cost itself. Land is not depreciated at all. So on 1st January, it was classified as IAS 40. And till end of 31st December 2000 X7, this is classified as IAS 40 investment property. The standard says that the date at which you classify it as an IAS 40, you have to calculate the fair value of that asset. Now, what is the fair value of the asset on 1st September? What is it given? Right? They were unable to identify the fair value, correct? So if you are unable to identify the fair value, as per the fair value standard, you have to identify the fair value based on similar assets, isn't it? Correct? That's what, the fair value model says, isn't it? Right? IFRS, if I'm not wrong, it was IFRS. Correct. IFRS 13 says that if you are unable to identify the fair value of a particular, item, you can use level 2 or level 3. It should be considered as a level 2 or a level 3. You don't know the value of that land, so it's not a level 1 item. It's a level 2 or a level 3, correct? So if it is a level 2, you can see what is the nearby value of an asset, and that is available over here. A nearby plot of land with a similar legal complication was sold for 11 million. So the fair value of the plot will be $11 million. Correct? And the standard says that on 1st September 2000 X7, whatever is the fair value of the plot, which is $11 million, minus the carrying amount, which is how much? 10 million. This will be considered as a revaluation gain, which will go to OCI. Understood? Which will go to OCI. Because till 1st September X7, it is still considered as a investment. It was considered as a property, plant and equipment. Only after the 1st September is over, only after this period, it is considered as a IAS 40 investment property. So the difference between the fair value on 1st September 2007 minus the carrying amount will be recognized in OCI. At year end, what happened? At year end, what happened? Year end, the fair value was how much? $11.5 million. This is a subsequent gain, isn't it? So on 31st December 2007, there has been a subsequent gain of how much? Fair value on 1st September X7 was $11 million. Fair value on 31st December X7 is how much? $11.5 million. So 0.5 million is a gain, which will be recognized in profit or loss. Right? So what was the incorrect treatment that was made? The incorrect entry that was posted was debit, land, credit, P&L of how much? Of how much? 1.5 million, isn't it? That is wrong, correct? 1.5 million. This is wrong. Correct? What is the correct treatment? The correct treatment should have been debit, land, correct, which should have posted on 1st September X7, debit, land, credit, OCI of $1 million. Right? And then 31st December X7, what we should do? Debit, land, right? And credit P&L of $0.5 million. Isn't it? So what is a correction entry? To correction, what we should do? Debit P&L by $1 million and credit OCI with respect to $1 million. Why? Because they have already posted. I'm sorry. Yeah, we can say, yeah, debit $1 million and credit. Yeah, and then we can say, yeah, 1.5. Yeah, we can say, put it in this way. How do I correct this? Debit, sorry. No, this in what was the incorrect entry posted? 1.5 million. Yeah, this is correct. Yeah. You understand? See, because it was 1.5 million posted, isn't it? Right? So when I'm debiting the P&L by 1 million, what is remaining? Only $0.5, correct? Isn't it? And when I'm crediting 1 million, I'm posting this entry. Right? So 0.5 will be remaining in credit as a P&L, correct? Of 0.5. You understand? And thus 1 million will be credited to OCI. Is this clear? Right? So you don't need to write in journal entries because that is not tested, but I've just shown this to you for your understanding. Now, what you should write it as an answer? Your answer should be written first and foremost, your the standard, right? The standard says that any item where there is a transfer of investment property from IAS 16 to IAS 40, the fair value of the land should be calculated. Fair value of that asset should be calculated at the date of the transfer. The difference between the carrying amount and the date of the and the fair value should be treated to OCI. So here the cost of land was correctly recognized as per property, plant and equipment on December 31st. However, when there was a change in the model from business owned property to rental income, it should be recognized as an investment property from IAS from 1st September 2007. As per IAS 40, gives entity a choice of accounting policy either as a fair value model or cost model. Correct? IAS 40 states that the fair value of an investment property is not readily available, then entity should use what model? Cost model. Correct? Right? It is only exceptional cases that the fair value of the investment property cannot be measured reliably. Here, isn't it? Here in this case, CL has a good understanding of how to determine the fair value of the land, right? Right? And the similar plot was sold for how much? 11 million. Hence, as per IFRS 13, this land would constitute a level 2 or a level 3 based upon the market approach. So when an owner-occupied property becomes an investment property, CL should record the difference as what? As a revaluation surplus. So on 1st September, CL should recognize a gain of $1 million in other comprehensive income. So the subsequent gain of 0.5 should be recognized in profit or loss. However, what did they do? They have recognized the entire gain in profit or loss of 1 million. Hence, CL should rectify this by posting an entry of debiting the P&L by 1 million and crediting the OCI by 1 million. So you are suggesting also that there has been some incorrect treatment, which will help you to score the marks. Is it clear? Since it's a very simple question, I'm not going to answer this, right? Because it's a simple standard. I'm not going to waste my time to answer this because it's not a waste of time, but it's very important that you do certain questions. Okay. Any questions? All right. So let's take a break. Okay. There is one more question that is left in this. Then we will do that question and then we will, continue with the next question, next section C question, section B question. I'm sorry. Okay. So we'll take a break of 15 minutes, 15 to 20 minutes. Okay. We'll put it as 20 minutes. We have a longer session. So 20 minutes for break. Okay. So let's continue with the last question for this particular scenario, which is option to purchase a building. The functional currency of CL is dollar. On 1st December, CL paid $10,000 to property developer for an option to purchase the situated overseas at a fixed price. The payment of the property is non-refundable. CL believes it is highly probable that it will purchase the building. CL proposed to treat the contract as a derivative financial asset measured at fair value to P&L in financial assets for the year ended 31st December 2007. Now, do you think that this particular transaction should be considered as an option as per IFRS 9? What do you think? Will it be a IFRS 9 derivative contract? No, it will not be. Why? Because first and foremost, there is physical delivery of an asset and you have paid an advance. It's considered like an advance and you have taken the physical deposit. Oh, sorry, you have taken a physical, you will be taking a physical delivery of an asset because since it will be settled by a physical delivery. This means that it was not accounted as a derivative. The option to buy the building for the purpose of receipt of a non-financial asset is outside the scope of IFRS 9. Okay. Considering the contract will be settled on a physical delivery of the building. Only net, if it is settled on net cash basis, it will be considered as what? A derivative. All right. The payment will be recognized as an asset, right? So this amount of 10,000 dinars which you have paid will be kind of like a prepaid amount, isn't it? Prepaid for advance paid for building, correct? And it will be a non-financial asset. isn't it? And as per IAS 21, the changes in effects in foreign exchange, it will not be retranslated. Why? Because the asset is non-refundable, correct? Right? So a non-monetary item, which means that it will not be retranslated to the reporting date, isn't it? Are you following me? Yes, no. No, you didn't understand. Shreya. Okay. So first and foremost, is this an option? It's not an option. First and foremost, it is not a derivative. Why it is not a derivative? Because you are taking a physical delivery of the asset. So hence it is not as per IFRS 9. So if it is not as per IFRS 9, then how will you account for this 10,000 dirhams, dinars that you have paid? Not just conversion, but what it will be, what type of transaction? It will be an asset or expense or a liability. It will be an asset. It's a prepaid asset, isn't it? Correct. So debit prepaid asset for building, credit cash. Dinars, whatever is the conversion rate, you will convert it. Clear? However, whether this asset of 10,000 dirhams, will this be so-called, will this be, sorry, will this be converted into, which will this be retranslated at the year end? No, it cannot be retranslated. Even though it is a foreign exchange, you have paid a prepaid asset for as an advance to the building. It cannot be retranslated. Why it can't be retranslated? Because first and foremost, this amount is non-refundable. So it doesn't get converted into monetary value. So hence it is a non-refundable amount. It's a non-monetary item. Hence it is not retranslated at the reporting date. But when you enter into this transaction on 1st December, the 10,000 dinars should be converted to its functional currency at the exchange rate, whatever is the rate at the purchase date, isn't it? Correct, right? But it will not be converted as per IAS 21 exchange rates. Is it clear? Understood the concept? Right? Yeah. Okay. Let's go to the next question. Now, this question is a very important question because it's something that is affecting our new topic, which is sustainability reporting. Okay. And it's a core theory question. And it's also a little bit difficult question because if you look at the requirement, you will understand. Okay. So firstly, the requirement. Briefly discuss how the materiality approach is different in European standard compared to IFRS disclosure standards. So that is very simple. Whenever I see some direct theory questions, immediately I will try to answer it. So that 2 marks is done and dusted. Correct? So A, question 4A, and the first one is materiality. Correct? Materiality oh, I'm sorry. Yeah. Yeah. So materiality as per IFRS sustainability disclosure is based on financial materiality, which focus on how sustainability issues will affect the financial performance, financial position, and cash flows of the entity. Right? And materiality in European sustainability reporting standards are based on a concept referred to as double materiality. This focuses on financial materiality also focus on the impact materiality, which is how the entity impacts the environment and society. This means that the entities consider both what is material to the environment and what is material to them, and that the two assessments are interrelated and interdependent. That's what the materiality focus on, right? So materiality is focused on double materiality. Okay. So both financial materiality as well as the impact on society should also be considered in European standards, as that's because they focus on double materiality. Clear? Now let's look at the next one. Using exhibit, right? Using exhibit 1 only, discuss why Kimimila company sustainability report does not comply with IFRS sustainability disclosure standards. So we need to review the sustainability report and mention why they do not comply with the sustainability standards. So sustainability standards are what? IFRS S1 and IFRS S2. IFRS S1 states that all about the sustainability impact and opportunity, right? IFRS S2 talks about the climate related issues. Correct, right? That's what IFRS S2 talks about. So we are required to look at the impact. We are required to review that particular disclosure standards and check what exactly is the issues that we are identifying in terms of the sustainability report. Okay, so first let's read that particular report. Kimimila company has produced a sustainability report. The sustainability report relates to that it has been produced in accordance with IFRS standards. Due to systems issue, Kimila was unable to capture the important data of December X7. As such, its sustainability report covers the 11 months to 30th November 2007. So there is an issue here, right? Because as per the standard of sustainability reporting, it should be a report that should be prepared for at least 12 months, right? So 12 months report should be prepared, correct? So it should cover for the entire same financial reporting period, which is for the of the company. Company's financial reporting period is till 31st December 2007. So they have to prepare a report which is as of 31st December 2007 for the entire covering the entire financial accounting year of 12 months. So this is one of the issue that we can discuss, which is like timing. In its climate disclosure, Kimila has identified several climate-related opportunities. It has also identified climate-related physical risk. but no other types of risk. Okay. For the risk opportunities identified, Kimi Miller has disclosed the potential impact on its financial position and performance over the next months. So there is a problem here. See, how did I identify that? It's not because I remember the entire topic. It's because of this sentence, right? So now we can get some sense into our mind that, okay, sustainability report has some kind of additional risk other than what is mentioned in this. What is the risk they have mentioned? Physical risk. But what are the risks that we are expected to report? Open your sustainability related topic in your textbook. I will also open it here. So the risk as per IFRS S2, the sustainability reporting says that you have to report on not just the physical risk, but also the yeah. Yeah. So these are the two risks we have to report on, right? What are the two risks we have to report on? Physical risk as well as the transition risk, right? So here they are likely to report on not just the physical risk, but also the climate related transition risk, which might reasonably be expected to affect the entity's prospects, right? Now, what is this type of entity? Entity is a what type of entity it is? Let's look into that. Okay. If you read here, okay, yeah. In Camilla has disclosed scope 1 greenhouse emissions. It does not disclose the scope 2 and scope 3 greenhouse emissions on the basis that these figures are likely to be measured. So there is something that in relation to this we have to identify. Camilla believes that this level of measurement uncertainty would not be useful to the primary users. Several years ago, Camilla introduced a share-based payment scheme for its directors. The option vest 31 on 31st December if Camilla cuts off the scope 1 greenhouse emissions by 10% on an average. This target was not met and the scheme did not vest. No mention is made of this share-based payment in the climate-related disclosure. This is a achievement, right? This is a metrics. So whatever the climate-related metrics, we can mention this. So here they are seeing that as a target, they are giving to a share-based payment directors a climate-based control, correct? So that is something that they can disclose in. Company should disclose whatever climate-related targets which it has set to monitor its progress, isn't it? And the share-based payment was a clear target, and that target should be reported. Yes or no? Right? And then the climate-related disclosures details Camilla's target becoming net zero within the next decade. Right? Around half of its anticipated carbon reduction is estimated to arise from carbon credits. There is no reference of this use of carbon credits in the disclosure. So that has to be disclosed, isn't it? So Camilla uses carbon credit, and as per IFRS S2, they should have disclosed the fact that 50% of the reduction have been achieved, isn't it? So whenever we are mentioning a target, you have to mention your metrics also, which means what is the target that you have achieved. So 50% you have achieved, which means that should be mentioned. Only then, the credibility of the report will be assessed. Correct? Further, only if you mention the metrics, users will understand that you are working towards your target. Otherwise, they will feel that you have just mentioned your target and you have done nothing. Isn't it? Is this clear? Right? Financial asset. Okay. Let's not discuss into this particular aspect now. So share-based payment. Okay. Yeah. Degree now. Okay. Camilla has identified several risks. Okay. Potential. Okay. So let's see. Let's do one thing. Let's try to read other documents also relating to climate change, scenarios also with related to climate change. See to check if we are able to generate some kind of information. Okay. Camilla is currently used the impact of climate change on its financial statement. Camilla has extended loans to its key suppliers to ensure their viability. Camilla has recognized these loans as financial asset. Camilla has loans and of this type with intention of collecting contractual cash flows. Camilla and its suppliers affected by the wildfires and flooding. In addition, there have been considerable policy and regulatory changes which have affected all the parties. Significant uncertainty risk around the impact of climate change scenarios and its suppliers' business model. Deferred tax. Camilla has been making losses for the past 2 years. The losses can be carried out to reduce the future tax. Camilla has recognized material deferred tax assets. Many of the Camilla suppliers incurring cost in order to reduce carbon emissions in its production process. This will cause purchase raw materials used Camilla to increase. Due to an increase in popularity of electric cars, Camilla has a forecast decrease in demand of many of its product lines. Do you understand? And then, yeah, I think this should be fine for the time being. Okay. Now, what is Camilla? Camilla is what type of entity? Have they written it somewhere over here? Manufactures petrol car engines. Okay, this is very important, right? So since they are manufacturers of petrol car engines, what happens? There will be a lot of carbon emissions that they will be doing. They will be the ones who will be creating the biggest climate risk issues, isn't it? So all the types of risk, transition risk, right? Which is the, which is if they are switching, if the market is likely to diminish for lower carbon emissions, what is the risk for Camilla? That has to be disclosed, isn't it? Because here, if you look at here, they are mentioning this. Due to popularity of electric cars, Camilla has a forecast that decrease in demand of many product lines. So isn't that an impact due to climate change? Right? So isn't that a transition risk? Yes, because the market is transitioning towards a lower carbon emission models. Camilla's existing models are facing a issue in the demand. Right? That is called as transitioning risk. And this transitioning risk, which has to be disclosed, which will impact the future financial performance, position, as well as cash flows for over the 12 months should be disclosed. Is it clear? Right? So let's try to write this answer, okay, which is the second part. A2. Sustainability report. Okay. Number one, I'm going to write these as pointers so that it's easier for me to identify. So, reporting dates of, reporting date. So you can write that saying that, okay, as per so as per the IFRS S1, the sustainability report should cover the same reporting period as the financial report of financial report, which is 12 months period to 31st December 2007. Okay. Second one, right, is the risks. Okay. According to IFRS S2, users should be informed about the climate related physical risk and transition risk which might affect an entity's prospects. These are likely to be significant for Kimi Mila company because it manufactures car petrol car engines, and the market for these are likely to diminish as the demand diminish to a lower carbon alternative increases. Right? So, and further, for all risk and opportunities identified. So, as per sustainability reporting, what we are supposed to do for any risk and opportunities we have to identify, we have to mention the impact on its future financial performance, position, etc. Risk and opportunities identified. Kimi Mila company should disclose information about the impact on future financial performance and position. Further, they should also disclose the impact on cash flows over the next 12 months. Right? And as per IFRS S2, right, companies are required to disclose the impact over short term, medium term, and long term. Yeah. The third one is greenhouse gas emissions. So Kimi Mila company has only disclosed its scope 1 greenhouse emission. IFRS S2 states that entities should also disclose information about scope 2 and scope 3 because they are mentioning that they have not disclosed about scope 3, isn't it? Scope 2 and scope 3. Okay. Now, what is scope 1, scope 2, scope 3? Okay. So look at here. Greenhouse emissions. Yeah. Where did it go? Greenhouse emissions. Response. Okay, specifically scope 1, 2, and 3 measured in accordance with the greenhouse protocol should be used and subject to disclosures. Now, have they not mentioned anything further about greenhouse gas? greenhouse. Yes. Okay. So scope 1, 2, and 3 greenhouse emissions separates emissions into 3 categories, including direct emissions, which is scope 1, indirect emissions, which is from the purchased energy, which is scope 2, and then indirect emissions from the entity's activities is called as scope 3. Right. So it is easier for us to identify the scope 1, isn't it? Like, which is nothing but the direct emissions. What are direct emissions? Whatever you are emitting directly into the air or water. So because they are manufacturing units, they will definitely have gas emissions, which you are directly emitting out. Correct? So that is your direct emissions. Indirect emissions is from the purchased source energy. So whatever you are purchased, correct? And whatever is that should be your indirect emissions. But the other indirect emissions is what will be really difficult to identify, isn't it? Correct? So that's what we are supposed to mention. So I'm not going to go detail into this indirect emissions or direct emissions. Have they mentioned that about this in your study hub? Let me just check in study hub what they have mentioned. Sustainability reporting. Sustainability reporting. Sorry. Greenhouse. 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 Where is greenhouse? Single reportings. Okay. Financial capital. So they are not mentioning something which is specific to that of uh, greenhouse gas emissions. So these are the things that you need to mention. So let me just check. Yeah. Sustainability reporting, GRI, CSR, integrated reporting is already mentioned. Yeah, that's it. So we can just mention that, they are supposed to report about, because there's no other information that is mentioned, right? So I don't want to give data which is not there for your exam. Okay. So has disclosed only scope 1 emissions. IFRS 2 states that entity should also disclose information about scope 2 and scope 3 greenhouse gas emissions. Note that Kimi Mila company would be exempt from scope 3 in its first annual report produced under the IFRS sustainability disclosure standards. Further, what are scope 1, scope 2, scope 3? So scope 1, scope 2, scope 3. Scope 1, 2, and 3 separates. Okay, so you can write this sentence, right? Greenhouse gas emissions are separated into 3 categories. Scope 1, which talks about direct emissions. Scope 2, indirect emissions from purchased energy. Indirect emissions from purchased energy. And scope 3, other direct emissions related to the entity's activities. Other direct emissions from entities' activities. Okay. So you're just mentioning about the scope 3. Scope 1, scope 3. Okay. And then what happened? If you look at here, target was not met and the scheme did not vest. No mention was this made in the share-based payment in the climate disclosures, correct? So you have to mention about that, right? So you have to mention the targets that you have established. So the next one is targets. As per IFRS S2, I'm sorry, companies should disclose climate related targets which it has set to monitor its progress. The share-based payment was based on a clear target to reduce greenhouse gas emissions by an average of 10% per year. Kimi Mila company should have disclosed the metric used, the objective of the target, and the period over which the target is applied. It should also disclose the fact that it did not satisfy the climate related target. Okay. And finally, which is on carbon credits. So carbon credits. So Kimi Mila company uses carbon credits as per IFRS S2. It should have been disclosed the fact that 50% of its carbon reduction target is based on the use of carbon credits. It should have been disclosed the types of carbon credit used and other factors to help the users assess the credibility and integrity of carbon credits. Okay, right. You've written it down, no? All right. Okay. So now let's look at the next requirement. Using Exhibit 2, discuss the impact of the climate change on the following issues of the financial statement: financial assets and recognition of deferred tax. So what is the impact the climate changes have as on these financial assets and deferred tax is what the question asks. It's again a tricky question. We are supposed to score 6 marks. The number of marks are 6 marks. So it's a very difficult question. So because it's a new topic that we are dealing with, and what is the impact of climate change on a financial assets is something tricky for us to answer, right? So we should be very careful when we are approaching this particular question. So read this scenario again. Kimimila has extended loans to its key suppliers to help ensure their viability. Okay. Kimimila company has recognized these loans as financial assets. Kimimila holds loans of these type with the intention of collecting the contractual cash flows. Kimimila and its suppliers have been affected by wildfires and flooding. In addition, there have been considerable policy and regulation changes which have affected all the parties. Significant uncertainty around exists around the impact of climate change scenarios and its suppliers' business model. So because of this climate change issues, the suppliers' business model is getting affected. And to the suppliers, we have given a loan, isn't it? Now, as per IFRS 9, when we give a financial asset or a loan to someone, we should recognize that at cost, isn't it? At amortized cost. Correct? Yes or no? But because of this climate related matters, Kimimila's have exposures to credit losses, isn't it? Right? The fires, the policy regulatory, all this is actually could impact negatively for the borrower's ability to meet the debt obligation. Correct, right? So because of that, the assets could be affected by the climate change. How it will affect the climate change? Because of climate change, the suppliers, businesses are getting affected. If the supplier businesses are getting affected, they will not be able to pay us back. If they are not able to pay us back, what will happen? There will be impairment loss. Isn't it? There will be impairment loss. So this will affect the range of potential future economic outcomes. And hence, this climate change will be considered as a significant increase in the credit risk, and the loans could be credit impaired. And we should recognize a loss allowance for at least for either 12-month or lifetime expected credit loss. Isn't it? You see the linkage now? And this is what has happened in COVID also. And that's why they brought this IFRS disclosure, sustainability disclosure very clearly. Because of COVID, many businesses got affected, isn't it? So just imagine banks would have given loans to a lot of businesses, and the businesses, they are not able to pay back. So they have to recognize a expected credit loss model. And that happened only because of COVID. If COVID was not there, their business would have run smoothly, isn't it? Right. So that's what we should write, or that's what we should explain. So here, which is question B, right? Which is for financial asset, right? So the financial asset are measured at amortized cost and therefore fall within the impairment requirements of IFRS 9 financial instruments. Climate related matters may affect Kimimila's company's exposure to credit losses. The wild fires, floods, and policy and regulatory changes could negatively affect a borrower's ability to meet its debt obligations to Kimimila's company. Right? Hence, further, these assets could affect the climate change, these effects. So these assets could be affected by climate change, which would result in reduction of their worth of security for the loans. In recognizing and measuring expected credit losses, IFRS 9 uses all information that could affect the repayment capability of the debtor. Right? So hence, climate related matters may be relevant since it could affect the potential future economic benefits that could be received from the debtors. Right? So then Kimimila company should assess whether there have been significant increase in credit risk and whether the loans are credit impaired. The expected credit losses are required to be measured through a loss allowance at an amount equal to the 12-month expected credit losses or full-time expected credit losses. Clear, right? So because of the climate change, the person to whom we have given loans is getting impaired, credit impaired. So we have to recognize a impairment loss is what the final answer or outcome is. Let me give it back. Right? Now the next one is deferred tax. Kimimila has been loss making for the past 2 years. These losses can be carried forward to reduce the profitable taxable profits in futures. Kimimila has recognized material deferred tax assets in respect of these losses. Many of Kimimila supplies are incurred cost in order to reduce carbon emissions during the process. This will cause the purchase price of the raw materials to increase. Okay. Due to an increase in popularity of the electric cars, Kimimila's forecast demand decreased in many of the product lines. See, what does the standard says when you are having a deferred tax asset due to past losses, you should be having enough profits to recover those losses. That's what the standard says. Currently, Kimimila's expenses is going to increase further. Why it is going to increase further? First and foremost, because raw materials cost is going to increase. Second, demand is going to reduce. So can you say that because of this climate change uncertainty, right? Can you say that Kimimila might be profitable in the future? No. So if you're not profitable in the future, would you be able to recognize these deferred tax assets? No. So what we should do? What we should do? We will not be unable to recognize the deferred tax, or so hence the deferred tax should be de-recognized. Correct? Understood? Why? Because firstly, the suppliers have increased the cost due to reduced carbon emissions. Their cost have increased. Correct? So suppliers, when cost increase, our cost will increase. Correct? Our cost of sales will increase, which will reduce our profitability, isn't it? And we are uncertain because of this climate change when we will be able to generate a future profit, right? Hence, what will happen? You are going to get an impacted way of having a what? The deferred tax, which is you will be not able to recognize. Clear? So let me just write that also. Deferred tax asset. Deferred tax asset for deductible temporary differences and unused tax losses and credits are recognized under IAS 12 income taxes to the extent that it is probable that future taxable profit will be available against which those amounts can be utilized. Suppliers are likely to increase their prices, and this will lead to lower profits in future periods. Some of Kimimila's companies' products are likely to become less popular, and once again, this will have a negative impact on the future profits. The impact of climate change is creating uncertainty, and Kimimila cannot forecast future profits with certainty. As a result of above, the future profit may be less likely. Kimimila company may be unable to recognize the deferred tax assets or could be required to de-recognize the deferred tax assets which were previously recognized. Clear? Right? So, guys, it's a very important question. I would want you to take this note of these answers and ensure that you read this again one few days before your exam. And you also need to understand the impact of the standards due to climate changes. Because climate changes, then what will happen? You need to think from that particular impact on the accounting standard. Even share-based payment is the same way only. So if you look at here, the last requirement is share-based payment. On 1st January X4, Kimimila introduced a share-based payment for its 10 directors. Each director was granted 15,000 share options. The fair value of the option at the date was 8. The option would vest on 31st December if Kimimila cuts its scope 1 greenhouse by 10% over the 4-year period. At 31st X6, none of the directors of the company were expected to leave in the next 12 months. Kimimila was on track to meet the target, meaning the share options were expected to be met. The share-based payment scheme was correctly accounted for the year ended 31st December 2000 X6. At 31st December X7, due to unanticipated changes in production process, the greenhouse target was not met. See, when you are on target to meet a particular metric for share-based payment, you will recognize an expense, isn't it? Because as per share-based payment concept, what will you do? Is this a share-based payment based on equity settled or cash settled? It is equity settled, right? Because you are issuing what? 15,000 share options. So share options is an equity settled. So equity settled means you have to recognize it at fair value. What is a fair value? $8. What is the vesting period? What is the vesting period? When did you issue it? 1st January. So what is the vesting period? 31st December 2000 X7. So how many years? X4, X5, X6, X7. 4 years. So 4 years is the vesting period, right? And what is the fair value at the grant date? $8. Correct? So on 31st December X6, how will you recognize this? 10, how many directors are there? 10 directors, correct? So look at this. How will I recognize this situation? So this is, I'm sorry, C, share-based payment. Okay. See, I'm just going to show the workings. Okay. So on 31st December 2000 X6, correct? Number one is that the greenhouse target was expected to be met, isn't it? So what will you do? You will recognize an expense as well as an equity on 31st December X6. How you will recognize an expense? Right? The total expense equity would have been. So you have how many directors? 10 directors. Right? So what was the opening value was 0. So you can say this is your, I'm sorry, balance. I don't know what is the balance carried down, but in which case we'll recognize an equity directly. Okay. So you have 10 directors multiplied by how many options you are issuing? 15,000 share options. Correct. So 15,000 share options you are recognizing. Correct. What is the vesting period? 4 years. How many years have been completed? X 2000 X4, 2000 X5, 2000 X6. So 3 years have been completed. So which means it will be 3 by 4 into what is the fair value? $8. So what is the amount? Can you just calculate it? Okay. right? How much? 900,000, right? So the entry would have been debit expense $900,000 and credit equity $900,000, correct? On 31st December 2000 X7, what happened? What happened? On 31st December 2000 X7, the share options did not vest. Why? Because the condition, the performance condition was not met, isn't it? Right? Hence, the expense and equity should be reversed. Understood? And this performance condition is a non-market performance condition, isn't it? Yes or no? Market-based performance condition means based on the market value of the shares, isn't it? Or profits, etc. But this is based upon the non-market performance, because it's like you are to reduce the greenhouse emissions, then you will get the share options. It's a non-market based, correct? Is it clear? So what does the standard says? As per IFRS 2, the expense should be recognized in respect of the share-based payment over the 4-year vesting period, isn't it? Depending upon the number of options to be vested. This is an equity settled scheme and the expense is measured at the fair value at the grant date. And what is the fair value? $8 per option. So at 31st December 2000 X6, the non-performance condition of greenhouse was expected to be met, and hence an expense was recognized to the extent of 900,000. However, as per 31st December X7, the share options did not vest because the non-performance condition did not met. And because of that, 900,000 of expense and equity should be reversed. Clear? Any questions? Understood the concept? Right? So, with that, we have completed this entire question paper. Okay. Now, I want you to prepare the summary of the question paper and read it when you have time. Now, what my analysis of this question paper is that, and this was something which has been very recently discussed, okay, which is like last couple of semesters back. So don't think that these kind of questions will again be repeated. No, we cannot predict anything. So I would say, recommend you not to predict anything based on this question paper. But a few learnings from this question paper is that number one, there are always easier marks to score. Like for example, consolidation were actually easier marks. Section A also, in second part also, there were easy marks to score because it was all straightforward questions. In section B, the first question was a bit straightforward. There were few questions which were difficult, like maybe the first one, bundled goods. Okay. It was a little complicated, but still it was straightforward. We would be able to score marks, correct? But few questions were very difficult. I felt that few questions were actually a little more difficult. For example, discontinued operations. It was not straightforward. There were some confusions in relation to the discontinued operation, right? The first time I'm seeing that a license is being charged as a discontinued operation. You understand? So those kind of confusion elements will come for your exam, but when you read the scenario itself, you will get a clear idea what the scenario is suggesting you to do. You understand? Land was very simple, nothing complicated. Even option was very straightforward, right? But few standards, two standards were actually tested. For example, IAS 21 as well as IFRS 9. So it is very vital that you write that this is not an option, derivative contract. But at the same time, it is very important that you write about the foreign exchange currency movement. Do you understand? Students might miss that part. They would have identified that it is not an option or it is not a derivative, but they would have missed the second part. And finally, the last question was, I felt it was really difficult. It was really challenging. It is one of the most challenging question of this particular exam. Okay. So I would recommend you, this is the only reference we have in terms of the sustainability related questions, because it is not a question that is very frequently tested, because why? It has been announced very later only. So I would recommend you to study the sustainability reporting, open the practice questions in your ACCA study hub and do a lot of questions on sustainability reporting. You can expect certain questions on that. Okay. And they have tested a lot of sustainability related areas in this climate based and all those things. So you can expect similar questions being asked in other standards as well, like climate-based impact in IFRS 15, climate-based impact in maybe in non-current asset. So you can expect such questions. But one thing that I would like to tell you is that, see, whenever you are facing a challenge, like for example, you are facing a question where you are not aware of the parts very clearly, one thing you need to understand is what the standard says and write whatever you know about the standard. Even if you are not able to link it very well to the climate part, it is still fine. You will score some marks, right? Second thing I would like to tell you is that when we read the sustainability report, see, there were a lot of yellow ones clearly says that they have not done this. So they are giving you indicators saying that this is not have been done. So all you need to do is that you have to report it. But it might not be some really straightforward like this, but the only way for you to learn about sustainability reporting is to read that note and keep reading it, because it's a new concept. I am little skeptical that it could be tested. At least for 5 to 10 marks, it can be tested, right? See, clear, guys? So do expect a question from sustainability reporting. It's a relatively recent concept, so you can expect. But however, whenever you see a question which is not understand, you are not able to understand the impact of the financial statement, all you need to do is remember the standard. Write the explanation of the standard. Try to link to the scenario as much as possible, right? To score the marks. You understand? But just because you don't know the standard, don't leave it. And don't write according to the marks, but write according to the points. So if it is 8 marks, don't think that you have to write 4 paragraphs, 5 paragraphs, 6 paragraphs. No. What is the standard? What is the impact of that scenario to the standard? And what is your conclusion? These are the 3 elements which you should be vital for your explanation. Okay. And understand the difference between explain, discuss, etc. Right? Discuss. Discuss means you have to discuss with the positives as well as negatives. Isn't it? That's what we did in sustainability reporting, correct? Briefly discuss. So discuss also is with the positives and the negatives of this particular aspect, isn't it? Right. So, and in explain, you just show the impact. You're not discussing the positives or negatives. What you're doing, you're just explaining the accounting impact. Whenever there is discussion, you have to critically evaluate, which means you have to give the positive aspects as well as negative aspects of this particular criteria of that particular situation. This is clear, guys? So read that verbs, prepare that verbs, keep reading that verbs and keep reading your question papers. Likewise, you do multiple questions, it's going to help you. Okay. Any questions? Fahim, do you have any questions? All right. So with that, we will close for today's revision session also. We will discuss tomorrow. We will discuss a few questions from our revision kit or maybe from our practice platform or wherever is possible. We'll discuss few questions and we will close the day for the question practice session for revision class. Clear? Yeah.